Good morning. Welcome to Accounting 3352, Intermediate Financial Accounting 2. It has been a long time we meet in the class, so situation is a little different. So we will just take a few minutes for this to work. Now, I don't see why they cannot display on both, but it seems I think it takes time for it to for this. Okay, I just got a lot of messages this morning and about how the course is delivered. So I just sent an email, like, so you are here, I can explain for the people who are tuning in, coming in from elsewhere. So this course is offered both in person and asynchronously online. And there are actually 3 ways to join this course. Obviously, in person here is one option. You can, like, if situation changes, like hopefully not, you can also tune in just by the Zoom. And our meeting is also recorded and it will be posted. So you can also view the lecture that at a different time after the class is done. There is quite a bit of lag between the actual lecture recording to when it's available to post, a few hours, but these are the 3 options. You can also combine it. Some people would like to join the class, you know, when they can, but also at other times they will just tune in from home or not tune in at all, view the recording. So we have all these options. Now this one, the online one is not working. Let me just a quick check the people who join us through the Zoom. Can you hear us all right? Just send a message if you could, and or send a message if you cannot. Okay. Yes, okay. Everything is online, it's fine, but I don't, just give me a second to check the projector. That looks everything. Oh, here we are. Awesome. I don't know why they cannot display on 2 screens simultaneously. I will investigate that after the class. So we will manage it with the 1 screen today. So any questions about that? If not, we will start. So today I have posted the materials we are going to work on online. So we will have a quick orientation of the course, and then we will start with a review. Okay, so let's just go over our course outline together. Let's share a course outline together. Find them. slide. Oh, here it is. Okay. Okay, let's see if that will do the trick. Let's share that document. What did happen to my meeting? Okay. No. Oh, here it is. Okay, here it is. Let's see if we can. Okay. Sorry about. Okay. So now, I will. Yeah. Okay. Let's go over our course outline together. So I want to highlight a few things in this course outline. So this is the last of a series of 3 financial accounting courses. And in this course, we cover some advanced topics, the topics that are less straightforward and a little complicated. Okay, so namely, we're talking about the complex financial instrument, earnings per share, income taxes, lease, pension, and the statement of cash flow. Those are the 6 main topics we're going to cover in this course. Because this is the last of the 3 financial accounting courses, so with each topic we cover, I would like to highlight one important aspect of financial accounting, give it a theme. So hopefully by doing that, we're not just covering those topics per se, we elevate it a little bit, look at the financial reporting conceptual framework that's applied in that, and give us a broader view of the issue. So for instance, the first chapter that's in this course is a complex financial instruments. And I picked the issue that's most highlighted in this chapter, that is the accounting measurements. And accounting measurements is not new. We have been using it all 3 accounting, all 2 you completed financial accounting courses, but we'll highlight that issue and see how it is applied in this more complex situation. Okay, and for next chapter, earnings per share, we will highlight the stakeholders' claims. Okay, like the financing structure of organization, various contributors of capitals and their claims on the balance sheet. And again, those are not new, but hopefully we look at it from a more elevated perspective, so that will help us to tie the things we have learned before together, review some of the things we already covered, and hopefully that will benefit more by doing that. So that's the structure of the course. The textbook I listed here. So since we have an arrangement with the Wiley Plus, so you guys already have purchased a textbook that covers this course, and that is more than adequate. That textbook is very complete, has lots of details, and I have a alternative optional textbook. This book kind of has a more clear, focused, streamlined coverage of the same topics. Now, I don't require you to go to purchase this book, but if you have a used copy, or you can borrow it, or you have any other way to access it, that should be good. I have one copy on reserve at the library if you want to check it out. That should be good as well. As I said, this is optional. Like some people find our textbook is difficult to read because the abundance of the details, and would like a more streamlined coverage. And so I offer you alternative. However, I will try to streamline in the course itself. So this is optional if you want to go the extra mile to help yourself, but it's not required. Okay. And the course evaluation, so we will have weekly quizzes, we will have chapter assignments, we have midterm and the final exams. So let me just explain a little bit. Now, I'll start with the chapter assignments because we have 6 topics. They are not really closely related with each other, right? They are like, each one is a somewhat unique. Accounting problems need accounting solutions. And so after each chapter, we will have assignments that aim to be comprehensive, covered topics in the chapter. Now, some of the chapters are quite long, and by now you all know financial accounting is a unique subject in the way that practice is critically important. So I have these quizzes on a weekly basis. I only give these quizzes for the week that there's no assignment due at the end of the week, and there's no midterm exam or final exam. So just so keep the pace of the course so you always have something to work on. Now, these weekly quizzes, they are timed. And so like usually you do that right after you cover the material. So my experience is it's hard to score very, very high. Okay, so I give the option that by the end of this term, if you want to transfer that 10% mark to your assignment marks, you can do that, conditional on you have done all your quizzes. So if you skip all the quizzes, then you are not eligible to that transfer. But even if you did not score high on the quizzes, at least you benefit from trying. Okay, so that's the intention of that. So if you have completed all your quizzes and you would like to have a higher mark because assignment, you have more time to work on it and the assignment is not timed, you can do that, but you need to try all the quizzes. So that's that. The assignments are individual assignments. It's not timed. It's not closed book assignments. You are encouraged to work with each other. Usually that helps a lot. However, if you submit your assignment, it should reflect your own work. Like I don't want you to hand an assignment, you can't explain it. That means you don't really know that, right? So you can get help, but when you submit it, you should be able to explain the work you submit. Okay, so that's my requirement. And trust me, that will work out well for you if by doing that, you learn a lot. Midterm exam is scheduled outside our regular class time, Tuesday, Thursdays. It's a Friday. I want to say September, no, October. I should know the date, but October 22nd, Friday. So it's outside our regular schedule the class time, so please take a note of that. If you cannot make it, you need to let me know 2 weeks ahead of time. And if, yes.
Is the mentor in person?
It's on Brightspace. It's on Brightspace. So you don't have to be here in person. Actually, you don't come to do it in person, but you have to be available to do it. Okay. Final exam is not scheduled yet. So make sure you don't make any plan that will cause potential conflict. Just wait. Yes?
Just to clarify, so if we already have the book, we still need to get the Wiley Plus again.
Now, okay, so most of us finished the 3352 not very long ago. Like as long as you use the same edition, you have this. If you purchase the 3351 with the same edition, there doesn't expire. Your old code should still work. Okay. Now it could only be problem if you taken 3351 using the old edition, or you transfer from another program which did not use this textbook. In that case, you can purchase this book. Just talk to me. I will direct you to the person that will help you to do that. Okay. But if you have the same textbook used before, it should still work. Okay. So these late assignment, missed test, midterms, and the other due dates, these policies are pretty much standard. So I will just quickly summarize it. There is for quiz, it's timed. You have to finish it by due date. There's no makeup for this because the whole idea is to, to keep the pace of the course. And as I said, you have an option to participate and then not to have those mark times, so you don't have to worry about I'm not ready to do it or some reasons. So in order to serve the purpose, I would insist you to stick to the timeline. Assignments, there are 6 assignments, 1 for each chapter, and they are, as I said, it covers a unique topic. So I will count them all. That's my plan for now. And I have posted due date way ahead of time, so make sure you know that. So I would expect you to be able to follow that. Midterm, by now you're familiar. There are certain circumstances, a special accommodation can be made. Basically, it's like serious illness or emergency that really prevent you from participate. If that's the case, let me know ASAP, if not beforehand, within 24 hours afterward. And if that's the case, that I can count final exam for both marks. So that's for midterm. For final exam, if for the same unavoidable reasons you cannot participate, I will give you one chance to write at a different time. I'll give you time to make up. Okay, so let me see. I think I covered most of the things on this. Yes, I covered everything. Before I leave this, the last thing is that after today, it's the first day, there is no quiz whatsoever, but I have a student information survey, which is in the format of quiz/exam. Okay, so I would ask you to do that this weekend instead of any content related quiz or assignments. There is no wrong answers because I just want you to provide some information that will help this course, help you in this course. If you participate, you get a participation mark. If you don't get participation mark. Okay, and that's one purpose. Second one, give you a chance to see what the test format will be like. Well, probably you are familiar with, but one more time it's not going to hurt. And so that's the few things on the course outline that I would like to highlight. If you have any questions, I would be happy to answer them. The assignment, by the way, would be given on Brightspace, and you submit on Brightspace. Quiz can be on Brightspace, can be on my business course. Okay, so it could be either way. Are you good about the course? Okay. Oh, I forgot to introduce myself. I'm Dr. Song. I will be teaching this course, obviously. And if you need to talk to me, you can email me. And if it's necessary, I can also schedule a Zoom in-person meet. I think that's now how the office hours is organized rather than meeting in the office. Just email me if maybe I can just reply your question on the email, but if it's necessary, we can schedule a meeting. No problem. Okay, so that's about the course outline. Okay, so now let's start on this. So I have to, for some reason. Okay, so I have posted this review question online already, and we can let me go over this together here again. Okay, so this is I picked this investment in debt security because the investment in debt security can be classified in 3 ways. All depends on the company's intention. Okay, so if it's classified differently, it'll be measured differently. So it's a perfect example to contrast different measurement approaches. Okay, so that's read the question. On July 1st, 2020, ABC purchased $100,000 12% XYZ bonds at par. On December 31st, 2020, which is end of the year, fiscal year end, ABC received the semi-annual bond interest payment, while the XYZ bond were trading at 102. So that means the price at that time is 102% of its par value. Okay, and on January 1st, 2021, ABC sold all XYZ bonds at 99. So that means the bond price had gone down. So the selling price is 99% of the face value. So that's the question. Okay, so this one, ABC follows IFRS. So IFRS allows a bond security to be classified as 3 different types of investment, and depending on what type investment you classify it, the way to account it is different. The way to measure it is different, right? The controller of ABC was advised that the investment in XYZ bonds could be accounted for at cost or at a fair value. If at a fair value, the changes in fair value could be put through either net income or other comprehensive income. 3 measurement approach here already, okay? And tie it to the investment, this will be the short-term investment, will be if the intention of the investor here, ABC, is to hold these bonds to maturity, right, that will be called held to maturity investment, and the measurement will be cost or amortized cost, right? So in this case, there's no amortization. Why? Because this was purchased at the par, right? And we know bond can be issued at a premium or at discount in addition to at par. And if the bond is issued at either at the premium or at discount, and you will have to amortize those bonds if you intend to hold it to maturity. And eventually the carrying amount will be same as the par, right? When it matures. Okay, so amortize is not issued because it's at a par already. So that will be just cost. Now, debt security can be also classified as trading securities, available for trading type of investment. Okay, so available for trading type of investment are more actively managed. So the intention is to profit through the ups and downs of the market. And because of that, the measurement approach for available for trading type of investment is a fair value through net income. Okay. The third alternative is if it's classified as available for sale. Okay, so it's neither held to maturity nor trading, then it will be available for sale. Then the measurement approach to use is fair value through other comprehensive income. So that's a read of that. Now, what does that mean? Does it matter how you measure it? We will work it out. I mean, the answer is obviously, yeah, why bother if it doesn't matter? And what do we mean it matters? What would happen for us to say, oh yeah, it makes difference, it matters? Well, it will affect the financial statements, right? It will affect what's shown on the financial statement. For instance, what's the value of investment? That's one. Secondly, what's the gains or loss on your income statement? That will affect your bottom line, which is net income. That matters, right? Like if by now we probably know, an earning announcement season, people pay close attention if the earnings meet the target or beat the target, the stock price usually go up. If an earning comes up, miss the target, that's significant bad news. The stock price usually go down. So that's what matters, right? And the timing of it, okay? So accrue-based accounting, timing is very important, right? Because there's no difference when everything is said and done, because how much you paid, how much you get in the end. Usually accrue-based accounting, cash-based accounting, cumulatively, there's no difference. The difference is the timing difference. In this period, what is recognized, how much is recognized. Okay, so that's the difference. Okay, so let's work through this question. And as I said, we'll just like, probably we'll go slow, just review this topic's already covered. And okay, so now given the situation we are in, so what I will do is I will use a PowerPoint slides, and I will write notes on that instead of here, so I can save it later and post it so we can share, right? So I created one, just give me a second to bring it up. And find out where, here it is. No. Okay. I will share this one. Okay. So I have not. Okay, so I just have some like a basic slides here to save the time. I have to type in the class. So this is our class note. It will be like that, and then we would use it as we go along, and I will. So this is the question. I put it here. So we just went over that, and here. So first of all, what would happen? I will put it here. Repeat the information we needed here. If this investment is classified as held to maturity, we start out with the journal entry. Okay, so the journal entry, if it's held to maturity on July 1st, that's the date the investment was made, we will have to record the investment. We will debit investment for the amount invested, $100,000, and that's it happened to be the par value as well. And then credit cash. That's $100,000. The fair value and the cost are the same on the transaction date, on the day of the investment. Right? So you paid $100,000 for these bonds, but the value of the bond could change afterwards. But on the day you invested, you are expected to pay a fair price. And so on that day, the fair value is the cost. They could deviate afterwards. And that's the case on December 31st. 2020. Two things happened here actually. In addition to the fact that the price is no longer at 100, there's also an interest payment. So I will record that first. So we have that's called interest revenue. So that is 12% a year. Semi-annual interest will be 6%, so that will be $6,000, and this will be cash. Okay, so debit should be cash, and the interest revenue earned should be a credit. So this is what we would do on that day. Okay. Format it a little bit, see if I can squeeze more in. Okay. Also, what happens about the fact that on that day, it's a fiscal year end, it's an accounting period end, and at accounting period end, we need to measure our assets liability properly in order to prepare financial statements, right? So we need to determine the value of the investment. On the balance sheet, at this point, it shows $100,000. Okay, now, because this is held to maturity investment, amortized cost method is used, that is just fine. We don't have to do anything. Okay, so I will just note it here, no adjustment to the investment is needed. It stays at a cost. Okay, so that's fine. And then next day, the first day of the next accounting period, the bonds are sold. and sold at 99. So that means for $100,000 bonds, we received $99,000. Right? That's what it means. 99. And now, since all the bonds are sold, so I would go to credit first, we should remove the bonds from our balance sheet. And the amount on the balance sheet is 100,000. Still at the cost. So the difference between the carrying value, 100,000, and the proceeds from selling it, in this case, is a realized loss, right? So this is realized loss. That's $1,000. Okay. Okay. So those are the journal entries required throughout the investment in this XYZ bond. And we, yes.
Sorry, how did you get the 99,000?
This last sentence here on January 1st, 2021, ABC sold all XYZ bonds at 99. So that tells us the price on the day they were sold is 99% of the face amount. Okay. So this is pretty straightforward. We can just gauge from these journal entries that at the end of 2020, there will be set financial statements. In that financial statement, on the balance sheet, you will have this investment of $100,000 as an asset. And in the income statement, it should include the 6,000 interest revenue. Okay, so that we impact on 2020 financial statements. In 2021, from same investment, you will have 1,000 realized loss. That's on the income statement. By the end of 2021, this will no longer be on the balance sheet. So we can see that, right? Okay, so what I will do is I will duplicate this slide. Okay, so now let's look at the second option. Second option is if this investment is treated as trading investment, then the measurement approach would be fair value through net income. Fair value through net income. Okay. Now, some of the journal entry will be different. Some will be the same. So we will look at these. On July 1st, 2020, same recording to record investment. Debit investment, 100,000, credit cash, 100,000. Okay, so it's the same. At the fiscal year end 2020, this is actually happened. The interest is received. We need to record that. Well, if you recall in accounting 2241, okay. So this is at the fiscal year end. The receipt of interest, it's a regular transaction, but the next one is part of the adjusting entries, right? Right. So this receipt of interest, that's an actual event that should trigger the recording. But because it's a fiscal year end, we also need to measure all the items on the financial statements. And if adjustment is necessary, we need to make adjustment. That will be part of the adjusting entries, right? So here, again, at the fiscal year end, and so the investment is on our balance sheet. However, fair value through the net income requires that investment to reflect its fair value on that date. The fair value is defined on if you were to sell them on that date, how much you can get. And we were told on that date, these bonds were valued at 102. So the price has gone up since they were purchased. And so we have to reflect 102,000 on the balance sheet. Adjusting entry will be adjusting the investment to its fair value. So that we need to do that and recognizing unrealized gain in income statement, right? That's what this fair value through net income implies. So not only on the balance sheet, this investment should reflect its fair value. Any unrealized gain and losses should go into income statement, becomes part of the net income. So that's what we need to do. This is okay. So I will do it here. The adjusting entry will involve an increase in the investment by how much? 2,000. And that 2,000 is a unrealized gain on investment. That's 2,000. Okay. So the financial statement will be different from the first one, right? On the balance sheet, we have investment. The value of the investment is 102,000 rather than 100,000. So that's one. On the income statement, the total investment income will be 8,000 under this approach, including this interest revenue and unrealized gain. Okay, so that's different. Now, questions? Okay, now when it's sold, the fact doesn't change, right? The fact doesn't change because you still sell it for 99,000 because the price is still at 999, but the carrying value now is 102,000. So therefore, the realized loss will have to be 3,000. Okay, so this is something, if you think about it, is in a neat in a way, because different accounting approaches does not change the facts. The facts is you purchased this investment at 100 and you sold it at 99. That's a fact. And the fact is before you sell it, you receive one semi-annual interest of $6,000. Just 1 second, but using different accounting methods result a different financial statement at a different time. Okay, so the income statement balance sheet of 2020 will be different, but the income statement of 2021 will be different as well. So in the end, the cumulative gain or loss would be the same. Doesn't matter how you count it. Sorry, their question? 2,000, it's this information here. On December 31st, 2020, ABC received the semi-annual bond interest payments while XYZ bonds were trading at 102. So that sentence tells us the fair value has increased, the fair value of the bond has increased since they were purchased. Okay, because it's in this situation, the investment is classified as trading investment. So fair value through net income approach applies. And that means on the balance sheet of 2020, you need to reflect these investments at their fair value. And the fair value, according to that sentence, is 102% of its par value. Okay, yeah. So let me just highlight these sentences. These are more like accounting term, but since we have to count them, we need to know how to interpret them, what they mean. Okay. Okay. So that's the second situation. Any questions? Okay, so now let's look at the third alternative. What if these investments are classified as available for sale? If that's the case, fair value through other comprehensive income will apply. Okay, so the difference between this fair value approach versus the second, the previous fair value approach is where the unrealized gains or loss go. Okay, the fair value part is same, so the balance sheet will be the same. The difference is the unrealized gain or loss is due to the application of fair value measurement will go into other comprehensive income instead of a net income. So that's the difference, and that will result different financial statements yet again. So on July 1st, no change, same recording. On December 31st, the interest will be recorded similarly. But what's different is, okay, also the investment will be adjusted to fair value, the same. The difference is recognizing unrealized gain in statement of other comprehensive income. So that's the difference, right? Recognizing the gain in the statement of other comprehensive income. That's the difference. Okay, so adjustment here is not that much different. So it's an investment, this unrealized gain, it's same unrealized gain, but when you prepare financial statement, it goes into other comprehensive income. So they will not show up in the income statement. Instead, they will be in the statement of other comprehensive income. Just to be clear, I will go back in the previous one. I will make it very clear. This one is part of the net income. Okay, so even though it's like the same account, it's unrealized gain, but it goes to different financial statement. This fair value through other comprehensive income means this unrealized gain does not affect your net income. Okay, so then when this investment is sold on January 1st, 2021, our journal entry will be different because that difference. So we have a cash receipt of 99,000. That doesn't change. Also, the investment that which were well valued at 102 fair value has to be removed. That doesn't change. Okay. However, there is one more thing, because now this investment is sold, any unrealized gain or loss that were included in other comprehensive income should be removed. There should be nothing unrealized anymore, right? Because the investment are disposed of. So we need to remove this unrealized gain from other comprehensive income, which is 2,000, we recognize. Okay, so like anytime you prepare a journal entry, a trick is you put it in the account changes that you are certain first. And when you finish all that, you have to make sure the total debit equals total credit. So sometimes you need to plug in a number to make that case. And this is the case. This is the case. We need to plug in this number. The realized loss is $1,000. The realized loss is $1,000. So that debit and credit are the same. Okay. Now, before we move on to the next bit, let me just say this. This is just an example, allow us to compare and contrast 3 commonly used measurement approach. And these fair value will be used a lot. Fair value through net income, fair value through other comprehensive income, and amortized cost. All 3 of them will be used in the chapter 16, we will start next week, right? But these are not the only measurement approach. There are other measurement approach. Can we name some? Sometimes we use discounted future cash flows. Remember that? And that is actually the approach to determine the bond price, right? If you recall, when we record liabilities, issuance of bond, so bonds do not have to be sold at their par value. And actually, you can't force that. The bond price is determined by economics, right? So it's the bond said that the cash flow, but depending on the market interest rate at the time, these future cash flow can be discounted to different present values, right? So bond price will be determined by discounted future cash flow. That's also a measurement of risk. There is also called the value in use, if you recall, and that's often used when we assess impairment of your assets, right? PPEs, and because PPEs are not meant to be sold. The purpose of acquiring PPEs is to use them for production, for operation. And therefore, to assess whether the value is impaired, we need to determine if we use it, how much value can we generate, and compare that value with the carrying amount. So that's another measurement approach. And there's also like a replacement value sometimes, things like that. There are different measurement approaches. Historical cost was the one that dominant before, but the other measurement approach has become more and more common in the current practice, fair value being one. Okay, so I just want to say that. So I mentioned a little bit in our discussions, but now that's just highlight, summarize the difference on the financial statements. So, so same problem, let's compare the impact on the income statement. So I will change that because that's its income on the income statement, right? So, so amortized cost would have 6,000 interest revenue in the income statement. Fair value through net income would have 6,000 interest revenue plus 2,000 unrealized gain. So that will be 8,000. Okay. Right. So I will maybe just put a note here so I can, so in case you want to be reminded. So that includes 6,000 interest revenue plus 2,000 unrealized gain. Okay. And if fair value other comprehensive income method is used in the income statement, 6,000 again. Okay. So that's what happened to the gain. $2,000 unrealized gain is included in other comprehensive income, not in the income impact on, I should say, income statement, IS, not, okay? So that for that, what about the balance sheet? Okay, so impact on the balance sheet sorry, that's the income statement of 2020, not 2021. Let's look at the income statement of 2021 since I have it here. Income statement on 2021. So amortized cost would have 1,000 loss. Yes. Yes, that's 1,000 loss. Realize the loss. Okay. Fair value through net income, our journal entry tells us that 3,000 realized loss, and fair value through other comprehensive income is 1,000 loss. Our journal entries clearly indicate that. Now, what you may want to notice is if you compare this income statement with the income statement of a previous year, and you add them together, that the total gain and loss are the same, regardless which method you use, right? So it's a timing difference. It's a timing difference. Cumulatively, the facts do not change. You paid $100,000 for the investment, you get 6,000 interest, and then you sold it for 99,000. That is the fact. That doesn't change, no matter how you count it. And the different way to count it achieved at recognizing the gain and loss at different time. And that's significant, right? Because on December 31st of 2020, using different approach, you see a two different picture. Okay, right. So then the last thing we want to look at is income impact on the balance sheet of so that's it. moment in time, no longer a period of time. So we need to say on December 31st, 2020, the difference between income statement and the balance sheet, right? One tells you what happened during the period, one tells you what's the situation on that date. So this is a moment in time. Okay, so this will be asset in this case. And on December 31st, amortized cost will show 100,000. That's the cost we paid to purchase the investment. Two fair values will show 102 each because balance sheet will be showing the fair value of those investments. Okay. So that's how the three different measurement approaches will be reflected in the financial statements. The last question of this little review is same scenarios. What if the company follows ASPE? Would everything be the same or not? No, why not? ASPE does not have such a thing called other comprehensive income. So fair value through other comprehensive income is not one of the measurement approach that it's available under ASPE. Okay, so that's very significant difference. And that difference will also show up in our discussion of chapter 16. Whenever fair value through other comprehensive income is is allowed under IFRS, ASPE would have to have a different rules to cover that because that concept does not exist. That's it. Whereas amortized cost, fair value through net income, they are both available under IFRS and ASPE. Okay, and so that concludes our review today. We finished a little bit early, so this will be the end of part of the lecture today. And for assignment, I guess it will take away from today. The takeaway of today, we review different measurement approach. Okay, and if you think about it, when we talk about accounting for anything, we are talking about the recognition, the measurement, and the disclosure. That's only three things we talk about. What do we mean by recognition? Should it be included in the financial statement or not? Not everything is included in the financial statement. If we decided to recognize something, next thing is what's the value of that something? Measurement. Okay, and then what additional information should be provided? That's disclosure. And the topics in this course, usually some of these, it's really straightforward. You have a cash sales. There's, you recognize it, and the measurement, the price you sold it for, right? That's straightforward. However, not everything is straightforward, and the items we're covering in this chapter, in this course, tend to be quite complicated in all three ways. Okay, so make sure you register for the course so you have access to the textbook, and make sure you complete student information survey before we meet the next time. Okay, so that's all for today. Thank you and have a good weekend.